In the past 16 months, the pound has fallen nearly 20% against the US dollar, and in recent weeks, the slide of sterling has accelerated, causing concern in markets that the UK economy is got a very poor long-term prospect. But what does it mean for the average household and business when the pound falls so quickly? Well, the most noticeable effect is that as the pound falls in value, the price of imports rises. Let's take a look at an example of a top-of-the-range iPhone that cost $1,000. Last year, the pound was trading at around 1.42 US dollars. So this $1,000 iPhone cost £704. Now today, the pound has fallen to 1.08. So that same iPhone now costs £926, an increase of £222 just because of the weakness of sterling, a 30% rise in price. And this is particularly noticeable for goods where we don't have any alternatives. So for example, with an iPhone, if you want the Apple, you have to buy an import. You can't buy a domestically produced one. Very importantly is oil and gas. These tend to be priced in dollars. So when the pound weakens, it increases the price of petrol and diesel just because of a fall in the currency. So the AA point to the fact that if the pound has stayed at its same value as February 2022 when the pound was trading at $1.35, then petrol would be at least 11p cheaper, which means when you fill a tank, you're spending £6 just because of a weakness of sterling since February of this year. Another problem of a weak sterling is that it exacerbates the problem of inflation. Now we have inflation running at around 10% because of rising energy prices, rising cost push factors, and also rising expectations. But the devaluation in the value of sterling worsens this inflation because the depreciation pushes up import prices, and it also maybe reduces the incentive for exporters to cut costs. This is more of a long-term factor. But in the short term, rising import prices directly cause inflation. And there's a little bit of a negative spiral effect because a weaker sterling pushes up import prices. This causes inflation. But inflation itself can weaken sterling because UK goods are becoming less competitive. Another big problem of a weaker sterling is that it puts very strong pressure on the Bank of England to increase interest rates, especially because there's so much market nervousness about the state of UK finances and inflation. And the mini budget has really caused a lot of concern in markets. So the bank is now forced to consider raising interest rates by quite a significant amount to try to shore up the value of a pound and prevent an outflow of money. But these rising interest rates will cause higher mortgages, higher loan fees, and higher debt interest payments on UK debt. And all this will cause lower growth, reduce household disposable income, and increase the debt burden for the UK government in the long term. So when the economy is weak and households are feeling squeezed, the last thing you want to do is to have to increase interest rates. But this is happening because of a weak sterling and also because of the expansionary fiscal policy, the tax cuts for high earners and corporations. So it's a kind of unfortunate situation. Usually, when a government announces an expansionary fiscal policy, it usually causes a rise in the value of the currency because markets expect higher interest rates. But the fact that we have a fall in sterling and rising bond yields shows that markets have a very dim view of UK prospects. And this is why the bank will be increasing interest rates more than perhaps it would like. Now, there are benefits, in theory at least, to a fall in the value of sterling. And certainly exporters will be quite happy because the fall in the value of sterling makes their exports much more competitive. They can even make a bigger profit margin, or they can cut prices to try and increase market share. Now, this benefit for exporters will be reduced if they have to import a lot of commodities and raw materials, because these commodities and imports will become more expensive for the devaluation, and this will counter the benefits of cheaper exports. By the way, if you're an A-level student and you struggle to remember the effects of a devaluation or appreciation, there's a simple mnemonic called SPICED. Stronger pound, imports cheaper, exports dearer. So a weaker pound the other way round. So if you get mixed up before your exam, just remember that you can't go wrong. Anyway, back to the benefits of falling the value of sterling. Another potential benefit is that you can improve the current account deficit, because this is a big problem in the UK, that the UK current account has widened in recent years, meaning that we import more than we export. And a depreciation in sterling should help to rebalance this, because it makes exports more in demand and it should reduce imports. However, again, it's not always that simple, because if you look at the current account in the past year or so, it's actually worsened despite the depreciation in the exchange rate. And this shows that demand for our exports and imports may be quite inelastic. And this means that even though the pound falls, you're not guaranteed to improve the current account. So, for example, in the summer we were spending 1.8 billion on gas imports, but the higher price of gas this winter is likely to push up the value of imports closer in the region of £8 billion, because it's more expensive and demand is very inelastic. We can't source it all domestically in this winter. So this is why that when we get a devaluation, the value of imports may actually rise, because we can't substitute to alternatives. At least it might take a very long time for firms to find alternatives. So in the short term, the fall in the sterling may not, unfortunately, improve the current account. Also, when looking at the effect of a fall in the value of sterling, it's very important to look at the economic situation, because we can look at examples where a fall in sterling was actually very beneficial. 1931, UK in the Great Depression, on the gold standard, interest rates too high, sterling overvalued, causing mass unemployment. The decision to leave the gold standard was a real boon for the economy. Pound fell, exports improved, interest rates could fall, and the economy recovered faster than, say, the United States. 1992, pound was in the exchange rate mechanism, overvalued, interest rates too high, trying to protect the value of sterling, and when they finally made the decision to leave the ERM, the economy recovered very quickly. It led to the long period of growth from 1993 to 2007, and it enabled interest rates to fall. But going back to 2022, it's a very different situation. The pound isn't overvalued because it's in a fixed exchange rate. The weakness of a pound more accurately reflects the weakness of the economy. The fact that productivity growth in the UK is quite low, that prospects for debt have suddenly got a lot worse. Inflation is one of the highest in the OECD, and the recent budget does nothing to assuage those fears. Also, if we look at the value of a pound in the past 100 years, you can see this long decline with some ups and downs. But basically, the fall in the value of sterling reflects the fact that the UK is less important in the global economy. It's declined in relative significance. We've become less competitive than other countries. Productivity has lagged behind. So the fall in sterling may give this very short-term competitive boost, but it doesn't lead to any long-term boost in competitiveness, because it's really the other way around. It's a poor economic performance causing the fall in sterling. And in fact, when sterling falls, it is argued that it may reduce the incentives for exporters to become more competitive and more productive, because they can rely on this short-term fix of a weaker exchange rate. But what you really want is really good investment to increase productivity and competitiveness, so the pound can appreciate and still be competitive. But that hasn't happened in the UK. The performance since 2007 is relatively poor compared to most G7 and OECD countries. So unfortunately, the fall in the value of a pound is not good news for the UK. It's true some exporters will be seeing an improvement in competitiveness, but generally speaking, the bigger picture is that it will worsen the UK's cost of living, worsen inflation, increase the price of imports, but also, most worryingly, it's a reflection of a market's view on the long-term performance of the UK economy and their prospects for the future. And the Bank of England may well raise interest rates to protect sterling, but that's not going to solve the underlying issues because it will worsen the cost of living, reduce demand further. And what the government really need to do is reverse completely their last mini budget to get rid of tax cuts for corporations and high income earners and show that the long-term finances are more stable. And they can do some fiscal expansion, perhaps higher universal credit or investment in green technology. But what they've done and their attitude has unfortunately been quite damaging to sterling. And if it doesn't change, then sterling slide may continue. I hope you've enjoyed this video. Lots to talk about at the moment. I know it's quite concerning from a UK point of view. But it is quite interesting from an economic perspective. So I'll be making more videos in the future. And if you like this one, please give it a thumbs up and feel free to subscribe so you don't miss any great content from Economics Help. Okay, thank you.